Well, we've heard from Fed Chair Powell and we've heard from President Trump. Apparently, the U.S.-Israel-Iran war has been paused, and there is a ceasefire that everybody is begrudgingly going to accept for now. And apparently, we are in no hurry to cut interest rates in any way, shape, or form, at least until we get to September. So where are we going now? That's what we're going to tackle here on Macro Money. This is Ilya Spivak, head of global macro here at tastylive. We're going to unpack here a little bit, first of all, what the markets did, and then what the actual substance of these comments from the Fed chair looked like, because, of course, the geopolitical narrative is pretty much self-explanatory here when we look at today's cross-asset performance. Stocks put in a cheery day. S&P up 1.1%. NASDAQ even stronger, clearly 3.1% there. Bonds edge up a little bit, which is an interesting sort of a reflection of what is going on here, and perhaps a slightly incongruous one if geopolitics were the only thing at play. But of course, they weren't, and so we'll get to that in a moment. But otherwise, a fairly risk-on day. Euro up against the dollar. Yen a little bit higher, perhaps echoing what's going on in the bond market with those yields coming off. Crude oil, of course, the standout, down another 5.08%, having fallen over 8% yesterday. Gold in by almost 2%. Bitcoin showing signs of robust risk appetite, rising almost 2.6%. So a cheery mood generally in markets, and bonds and the yen kind of the standouts that seem to hearken a little bit to what's going on with monetary policy and these Fed comments. So what we had today was the first day of testimony, semi-annual testimony from Fed Chair Powell in the U.S. Congress. We had the House of Representatives here first. Senate is coming up tomorrow. The prepared remarks should be give or take the same. The Q&A portion obviously is going to be different, and we'll see if anything emerges there in that Q&A portion tomorrow that clashes in any way with what we saw today. But at this point, it seems like we're in for a familiar story. So once again, from the prepared remarks here first, Chair Powell saying once again that the Fed is very much in a wait-and-see sort of mode, because they expect that tariffs are going to push up inflation and weigh on economic activity, but they don't know exactly to what extent and how all of this will look. And so they're waiting to make a decision. And in the meantime, with an unemployment rate at 4.2%, which is very low by historical norms, and an inflation rate that's almost to target, and certainly much closer to target than not, at 2.4% on headline CPI most recently, the Fed really doesn't have an impetus to go quickly this way or that. It can afford to wait to see the impact from the tariffs materialize whichever way it's going to. And we see here that the expectation is that's likely to appear in June, July, and August. We, of course, haven't seen that inflation data yet. We'll have to wait and see. But clearly, the Fed themselves are in watch and wait mode, as Powell said here. And the concern, of course, is that if the Fed is right and the tariffs are inflationary, they want to keep them to a one-off increase and not something that drives up inflation expectations. Now, in the Q&A that followed, we see reiteration that the Fed does want to cut rates, and a majority of policymakers think that's what's going to happen. But they can't be cutting, and the reason that they're not cutting is forecasting both at the Fed and more generally is pointing to a significant increase in inflation this year. And that's, of course, that tariff impact. Now, Powell goes on to say that if not for that inflation forecast, they would have been cutting already. But as long as the economy is strong, they can pause here for a bit. And that, of course, then gives us what our reaction function looks like. For the Fed to start to move on rates, they want, or they'll need to see the economy weaken. And that, of course, means that from the market's perspective, the Fed is going to be later than usual to the rate cut party. That the Fed is going to either wait for the tariff impact to appear, then dissipate, and hopefully with no economic consequences as far as a lasting hit to growth, or that lasting hit to growth appears, the Fed can reason that the demand destruction there will countervail whatever one-off price increase from the tariffs, and they can focus wholeheartedly on that part of it and cut. But short of evidence this way or that, they're stuck. This, of course, comports with the FOMC forecasting update, the summary of economic projections that we got last week. We can see here downgrades to expectations for growth, a parallel upgrade to expectations for the unemployment rate. So again, a weaker economy and higher inflation, pretty much across the board over the 3 years of the forecast. And what the Fed seems to be saying on the rates front is that because the impact of the tariffs they now expect to see in June, July, and August, and it's somewhat delayed, not surprising, of course, with the 90-day pauses that President Trump announced to the sort of full breadth of the tariff regime in April, where the tariffs, the reciprocal rates, so-called, on most trading partners go up in early July and on China in mid-August, unless, of course, these pauses are extended. We have this kind of delayed reaction, and in any case, the rise in tariffs takes time to work its way through the economy, much like rate cuts do, or rate hikes for that matter. It takes a while for the economy to absorb a level change in prices for goods, for services, and for credit. So what we have is the Fed then saying, before we thought we'd go 50 basis points in cuts this year and again in 2026. That's what you see right here in the March set of numbers, and that mirrors what they said in December. Now we see we're going to take a year longer to get to that second 50 basis points. Now we don't get to 3.4 until 2027. And so the full scope for rate cuts over the 3-year period here, we can see from 3.1 to 3.4, has been cut by one increment, by one sort of standard size 25 basis point step. And that elongating of the timeline here seems to occur starting from next year. Now, what's interesting is, on some level, the Fed has a point. The most recent PMI data does, in fact, suggest that the economy flirted with standstill earlier in the year, but has now kind of stabilized, it would seem, clearly at a lower level than last year, but not dissimilar from where things idled in 2023. So, on some level, the economy is not screaming for immediate firefighting. This is, of course, the latest update to the S&P Global PMI data, the June update. And as ever, PMI data is expressed centered around the 50 line, where that's neither growth nor contraction. Above 50 is expansion. Below 50 is contraction. The further you go above 50, the faster the expansion. The further you go below 50, the faster the contraction. So you see here, right at the beginning of the year with the onset of these tariffs and that growth scare that we saw from mid-February right until that crescendo in early April, there was a slowing down in U.S. growth to basically the 50 level across both services and manufacturing, and that, of course, took the overall economy the same direction. Now, obviously, there's been a slowdown versus the levels of growth that were on display in the second half of last year, but we're certainly off standstill now and back to basically where growth has averaged. It's been a slowdown, but not a catastrophic one, or not certainly anything that raises any eyebrows at face value. Moreover, just last week we saw that U.S. consumer confidence has meaningfully improved. The survey from the University of Michigan here showing that as inflation expectations linked to worries about the tariffs have eased, in June they've come down from 6.6 to 5.1%, so too consumer confidence has come off its critical lows going back 3 years to essentially the COVID bottoms and has started a meaningful recovery. So indeed, it does look like uncertainty is waning, the economy is holding up, and the Fed is not really getting yelled at by the economy, or so it seems. But the markets, interestingly, are of another view. And this is where there is a clear wrinkle in the narrative. At the beginning of the year, as we just saw that there was a growth scare and we had the bond market's inflation expectations head lower around the idea that what this growth scare would mean is a downturn in the economy and demand destruction. And this would mean that there is a pull down on prices as supply starts to overshoot waning demand. There's discounting, and invariably, as there is in an economic downturn, prices start to retrench, as it were. And what you have here then is a parallel decline in the S&P 500 here in the yellow, as well as break-evens for the 5 and 10-year maturities, sort of the liquid ones that you can look at as indicators. And obviously, since early April, stocks have almost fully recovered these losses as sentiment has improved, but these inflation expectations are still pinned. And after this little scare here around the spike in oil prices linked to U.S., Iran, Israel conflagration, now that that oil price spike has basically fully unwound, we're again pinned inside this range established all the way back now almost 3 months ago. And so the bond market seems to be saying the Fed's confused, but the markets know which way it's time to jump. They're not concerned about sticky inflation from the tariffs. They're concerned about an economic growth downturn that keeps inflation low. And in fact, you can see that disparity in full relief, as it were, in what Fed funds futures are telling us about where the markets think the Fed is going next year. The 50 basis points they anticipated for this year, the markets have matched, and that largely seems intuitive because, of course, the calendar is limited. The markets don't expect any rate moves in July. We can see that here. We're sitting at the median rate here for this month and next. We start to tilt a little bit lower come September, and by October and December, we have our 2 cuts. Now, what's interesting is that since the Fed meeting last week, this curve has actually become more dovish, despite all of the counter narrative from the Fed, including Powell's comments just today. And we can see here that for 2026, the wedge has increasingly widened, and now the markets actually see 61 basis points in rate cuts there. That's at least two, and about a 50-50 shot at a third. Whereas we just saw from the Fed's reckoning, they only see one. And so we now have a significant disparity between what the market says the Fed needs to be prioritizing and where the economy is going, and what the Fed anticipates. And what makes this ever sharper of a contrast is that the markets do seem to have at least the momentum behind economic data on their side. This is the Economic Surprise Index from Citigroup, and what it measures is how economic data is performing relative to forecasts. That is, whether economic numbers are beating or undershooting forecasts, and it's scaled by the volatility of the currency market's response to the data. So when data is more impactful, it impacts the index more. It's also skewed toward recency. And so recent misses impact the data more as well. So what we have here is a fairly clear story going back to the middle of May, where U.S. economic data is increasingly underperforming relative to baseline forecasts. In other words, the economy is turning out results that are worse than what economists' models say they should be. Now, we can clearly see that this is the main sort of drag on averages for the G10, as well as for the global index right here, because if we see what's going on with emerging markets, they're holding up fairly well. Here's that zero line dividing what's going on with surprises upside versus downside. Above zero is surprising upside. Below zero is surprising downside. Obviously, it's immediately jumping out here that the U.S. is the only line on this chart that's under zero. But also, we can clearly see that emerging markets are actually showing relatively upbeat economic data relative to forecasts after an improvement from late April onward. Similar story for the Eurozone. There we've seen improvement since about late April, early May onward, and the slope is higher. And so this weakness in the G10 index, clearly not Europe. This weakness in the global index, clearly not emerging markets. And so the U.S. is the weak link here, seemingly. That, of course, is a troubling sort of setup when we consider, as we often do, that global growth is primarily powered by three big economies: the Eurozone, China, and the U.S. And if we take a look at the current setup for how those economies are doing, we are in a story very similar to where we were last year. Notice that these are composite PMI indexes again, and these are for these three key economies. Here's the one for the U.S. We can clearly see the pace of growth here is nice and strong in the second half of last year. In fact, the strongest we'd seen it since early 2022. Meanwhile, through the second half of last year, growth rates in China come down and slow to standstill. The Eurozone attempts a shallow rebound after recessionary conditions in the latter half of 2023. That fails, and we end up at standstill once again. Now, we don't have June PMI numbers for China yet, so these are the latest numbers from May, extrapolated here in the orange to make them stand out as forecasts. The latest numbers from the US and the Eurozone came out just this Monday, and we see the very same story here. China and Europe are idling. The US is now a lower growth single point of failure. And if this gives way, as the dynamics here seem to suggest, well, then the global economy doesn't have much of a leg to stand on. Because if these two pieces are offline, and this one slows to a crawl, whereas the rest of the 42% are largely vendors depending on these three to feed them demand via buying their exports, once again, a global recession starts to get inescapable. Now, to the Fed's point, we're not there yet. And clearly, the U.S. economy is again holding up the entire pie. But if this continues to happen, that's going to become a very serious question. And as we look at this performance today, we sort of beckon to ask, at what point do markets bake in the sort of cheerful reaction to geopolitical de-escalation and get back to looking at the growth story? And of course, the Fed's own reckoning here that what they need to see to jump this way or that is some kind of clear give in the economy. And of course, raises the question, who ultimately is right? Is it the Fed in only forecasting 3 cuts between now and the end of next year? Or is it the markets who are leaning toward 5? And that is macro money for today. As ever, we are here every Monday through Thursday, right after overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I'm going to be back here in just 30 minutes' time, as I am every Tuesday, with Victor Jones for the Price of Truth. Back with Chris for Futures Power Hour on Friday. Back with Victor and Tom for First Call on Sundays. Writing for the News and Insights portion of tastylive.com and commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money is back tomorrow. Happy trading.